And hello, ladies and gentlemen, and welcome to this session on technology and banking. And yes, indeed, this is that dreaded post-lunchtime slot feared by speakers and audiences alike. But in fact, you might say that we're devoting the next hour and a half to a wake-up call, because in many ways, that is what technology and banking is all about. And as many of you probably know firsthand, technology is changing Europe's banking landscape, to pick up on the title of this year's conference, in ways that many of us hardly would have thought possible just a couple of years ago. Both artificial intelligence and blockchain are revolutionizing the way that both organizations and people interact with money in a wide range of financial services and in the area of insurance. 2016 has been seen by many experts as a watershed. In fact, it's been called the year that fintech went mainstream. And if you look at the numbers, just from mid-16 to mid-17, global investments in fintech increased 11% to a staggering $17.4 billion US dollars. Just in the second quarter of this year, over the first, they doubled. That has profound implications, both for the new guys on the block and for incumbents, as well as for regulators. And in our panel discussion later on, we want to talk about those implications. And you, ladies and gentlemen, hopefully will help us keep it lively by asking questions. Appropriately enough for a digital question, we're taking old school questions. You can raise your hands and ask them with a microphone. We are not using our devices on this one, just for a little bit of dialectics. So please do keep your questions in mind. But first, I would like to take just the quickest of polls to get a sense of how you see fintech, ladies and gentlemen. So first of all, how many of you have used some form of fintech, whether digital and or mobile payment, cryptocurrencies, investment and or stock trading platforms, or others? How many of you? Please raise your hand. Okay, very savvy audience. That's great to know. How many of you would say that the potential benefits of fintech outweigh the risks? And when I say risks, I mean everything from business model obsolescence on the part of banks to cybercrime, abuse of personal data, and also systemic instability. So how many would say benefits outweigh those risks? Okay, how many see it the other way around? All right. We'll see who convinces whom. Maybe we should take those votes again at the end. So let us now get started, and we'll start out with what is seen by many people as the driving trend in fintech innovation at the moment, namely artificial intelligence. Large banks and small startups are actively exploring ways that AI could reduce costs and improve client satisfaction. We begin with an impulse speech from the author of Rise of the Robots, Technology and the Threat of a Jobless Future. He's a futurist and entrepreneur. He has over 25 years of experience in the field of computer design, and he founded a Silicon Valley-based software development firm. He's consulted with Société Générale on creation of its new Rise of the Robots Index, which focuses on firms that are playing a significant role in the AI and robotics revolution. Please give a warm welcome to Martin Ford.
Well, thank you very much. It's really a great pleasure and also a privilege to be here to talk to you. For nearly a decade now, I've really been focused on the potential implications of technologies like robotics and artificial intelligence. And I've really come around to the view that we could very well be on the leading edge of a very substantial disruption. And I think it's a disruption that is going to completely redefine the way businesses operate and compete. And it's also ultimately, I think, going to end up putting a terrific amount of stress both on society and on the economy. Now, the issue that I've really focused on is the idea that smart algorithms, machines, robots are increasingly going to substitute for human workers. You know, they're going to take over more and more of the work that's now being done by people, and I think that ultimately, as that accelerates, it could lead to some real challenges for us. As I've been engaged in my research, I've had a chance to talk to a lot of the people that are really on the leading edge of these technologies. In other words, the people that are driving the innovations in AI and in robotics. And what I've found is that at least among that technical group of people, there is something of an emerging consensus that maybe we really are headed toward this big disruption, or perhaps we're even poised to enter an entirely new era, a time when maybe things are going to operate according to fundamentally different rules than what we've really seen in the past. On the other hand, there's a whole lot of skepticism out there about the idea that this time is somehow really different, and I think that it's probably fair to say that economists as a group tend to be a bit skeptical of, that this time is different argument. And the skepticism is largely based on the historical record. This concern or fear that machines might displace a lot of workers and maybe lead to significant unemployment, that goes back at a minimum 200 years to the Luddite revolts in England. And since then, the issue or the fear has come up again and again. I'm going to guess that most of you are probably not familiar with the Triple Revolution report. But this was actually a very prominent report. It was put together by a brilliant group of people. The team that wrote this report actually included 2 Nobel laureates. And this report was presented to the President of the United States, and it argued that the U.S. was on the brink of complete social and economic upheaval and chaos because industrial automation was going to put millions of people out of work. Now, that report was delivered to President Lyndon Johnson in March of 1964. So that's now well over 50 years ago. And of course, we haven't really seen that, have we? What has happened is that the economy has adjusted, or people have adjusted. They found other roles. They've moved on to do different things, and we have not seen this big disruption so far. So I think it's entirely reasonable to be skeptical, but at the same time, I believe pretty firmly that we may now be at the point where the technology is finally arriving, and that this time could well turn out to be really different. So what I'd like to do is begin by giving you just one number that I think is at least suggestive that maybe something interesting or different is going on. If you go back to 1998, in the business sector of the U.S. economy, there were, as measured by the Bureau of Labor Statistics, 194 billion hours of labor performed in total. Now, fast forward 15 years to 2013, and the output of the business sector grew by over 40%, or around $3.5 trillion. And during that same 15-year period, the population of the United States grew by 40 million people, which is a lot of people. That's roughly the population of Poland, which is, of course, one of the larger countries in the EU. So essentially, over that 15-year period, we added an entire country, a pretty large country, to our population. So we get to 2013, however, and it turns out that the total amount of labor demanded in the business sector was exactly the same, still 194 billion hours of labor. Now, the fact that we produced a lot more with the same amount of labor is in and of itself not that remarkable. I mean, that's really just a story of increasing productivity. But I do think the fact that there was no new demand for labor at all in the entire business sector, even after the entry of that many people into the population and the workforce, is fairly remarkable. And I think that what it sort of implies is that businesses are increasingly relying on what you might call digital leverage. They're relying on all this information technology to produce ever more output, but they're doing it in a less labor-intensive fashion, and they're doing it in a way that relies less on human labor. And as that accelerates, I think that it could lead to some real disruption. So given that I am making the argument that this time could well be different, I think it's really important to articulate what exactly is so different about today's information technology relative to the kinds of disruptions that we've seen in the past. And I would point to 3 fundamental things. And the first thing, of course, is that we have seen this ongoing process of exponential acceleration. And I think that nearly all of you have probably heard of Moore's Law, or this idea that, computers roughly double in power every 2 years or so. But actually, the acceleration is much more broad-based than that. It extends, for example, to communications bandwidth, to memory capacity. It extends, in many cases, to software, where in some areas of software we've seen an acceleration far in excess of what Moore's Law would imply for the hardware. But the other really key thing to understand is that this acceleration has now been going on for a long time. It's been going on for decades. If you measure from the late 1950s, when the first integrated circuits were fabricated, we've seen something on the order of roughly 30 doublings in computing power since then, which is just an extraordinary number of times to double any quantity. And what it implies is that we're now at a point where we're going to see just an extraordinary amount of absolute progress. Things are moving at a very, very rapid rate. And of course, they're going to continue to accelerate from this point. So what that means is that as we look ahead to the coming years and especially the coming decades, I think it's very likely that we're going to see things that astonish us in terms of what technology is capable of. And the reason is that things are now moving at just a very, very rapid pace, and things are going to continue to accelerate. The second key point that I would point to is that machines and smart algorithms are, at least in a limited sense, beginning to think. They're taking on true cognitive capability. And by this, I don't mean science fiction, artificial intelligence, or robots running around acting like people, or machines that can genuinely think like human beings. What I do mean, though, is that machines are making decisions, they're solving problems, and most importantly, they're learning. In fact, if there is one technology that is, I think, really central to this and has become kind of the driving force behind all of this, it's machine learning, which is just becoming an extremely, disruptive, powerful, broad-based technology. And it's essentially the idea that smart algorithms can churn through massive amounts of data, and based on that, they can learn, they can figure things out. And that's becoming just extraordinarily powerful. One of the, I think, most vivid demonstrations we've seen of that recently was what Google's DeepMind division in London did with its AlphaGo system, which you may have heard about. Now, the game of Go is an ancient game played especially in Asia, but there are two things about the game that really kind of stand out to me. One is that the game is extraordinarily complex, much more so than chess. As you're playing the game of Go, the number of configurations that the board can be in is almost infinite. I mean, there are actually more possibilities than there are atoms in the universe. So what that means is that you're never going to be able to build a computer system that can prevail at the game of Go the way chess was approached, which is just to throw raw, brute, computational power at it and have it look ahead and optimize moves in the future. You can't do that with Go because there's simply too many possibilities. You couldn't build a computer that fast. A second thing that really stands out is that if you were to sit down and talk to one of the very best Go players in the world, this person may not be even able to articulate what he or she is thinking as they're playing the game. Very often they will describe it as just a kind of a feeling that they get, that they should make a particular move. So when you consider those two qualities, what that suggests to me is that playing the game of Go, at least at a world championship level, really ought to be something that's safe from automation. It's something that really ought to be reserved for people. I mean, put yourself in the position of a computer programmer, imagining that you're interviewing a top Go player and trying to understand what they're doing so you can somehow put that into code. You don't even know where to start because they can't even tell you exactly what they're doing. So this ought, to my mind, to be a job or a task that's safe from automation. And yet Google was already able to build a system that not only taught itself to play the game of Go, but then very rapidly essentially became superhuman and can now beat any human being on the planet. So I really think that should raise kind of a cautionary flag for us. And what it suggests is that a lot of our assumptions about what kinds of jobs and tasks and roles are going to be safe for people and not subject to the impact of technology, a lot of those assumptions are sure to be challenged. I mean, this technology is going to move into areas that we really don't expect. I think that what we can say at a minimum is that almost any kind of job or task that is on some level fundamentally routine and repetitive and predictable, in the sense that that task is encapsulated in data so that the machine learning algorithm can can predict how to do that job based on what's been done in the past, that kind of work is going to be highly susceptible to automation, and it won't matter what industry or what type of work it is. But the experience with the game of Go and AlphaGo really suggests that it could go far beyond that, and it's really going to challenge a lot of our assumptions about what's going to be safe. The third thing that I think is really crucial is that information technology and increasingly artificial intelligence is really becoming a general purpose technology. And what I mean by that is that it's going to be everywhere. It's going to scale across everything. It's going to impact every industry, every employment sector. There aren't any areas of the economy that are going to be unaffected by this. A number of people have made a comparison between information technology and electricity, and I think that that's quite valid. And of course, you would never ask what industries are most impacted by electricity or what jobs are most impacted by electricity. I mean, everything relies on electricity. And it will come to be the case that the same is true of artificial intelligence. You know, everything will rely on it. And so it's going to be an incredibly broad-based, very disruptive impact. I think that is quite different from some of the impacts we've seen in the past. You can think of a classic example, what happened in agriculture. I mean, it used to be that in most countries of the world, I guess all countries, most people worked on farms and were engaged in food production. Then agricultural mechanization came along, tractors and combines and all the rest of it, and millions and millions of jobs were lost, so that now in advanced countries, maybe 1 or 2% of the workforce is working in agriculture. And of course, that did not result in massive unemployment, not in the long run, but agricultural technology was very specific and mechanical. It impacted one sector of the economy, and then people moved on to other sectors. You know, they moved on to manufacturing, and later on they moved to the service sector. This time we're looking at a much more broad-based impact, something that's going to really scale across everything, and for that reason I really do think that we could see a different outcome. One of the things that people who are a bit skeptical of all of this will be quick to point out is that there is this ongoing process of creative destruction. So we can acknowledge that many industries that exist today are going to be upended, maybe even destroyed by technology, but at the same time, entirely new things will arise in the future. And it's easy to, to anticipate what some of those are going to be, things like nanotechnology and synthetic biology and so forth. These new areas, these new industries are going to arise, and they will have to employ people. But there are good reasons, I think, to believe that these new areas may not be very labor intensive. They simply might not hire that many people. So what you see here is a comparison of a very traditional industry as exemplified by General Motors. And at its peak employment, GM had about 840,000 workers. Now compare that to Google, and after adjusting for inflation, Google employed less than 5% of that number of workers, but it actually earned 20% more than General Motors ever did. So this is another example of what you might call digital leverage. Google has become this incredibly valuable, powerful, influential corporation, but it's done it with a workforce that is really just a tiny sliver of what General Motors employed. It's also important to note that the people that Google hire are quite different from General Motors. I mean, GM created a lot of jobs for typical average people. Google, on the other hand, typically hires people from the very best universities in the world, people that have very, very high levels of capability and skill. So as we look forward, the point I'm making here is that the whole economy might gradually come to look more like Google and less like General Motors. And that could mean an absolute shortfall in number of jobs, simply not enough jobs to go around, and also potentially a skill mismatch problem where, to the extent that new jobs are created, they might not be a good match for a lot of the average people that really need a job. Here's another graph that shows a somewhat similar issue. I would also say this is about creative destruction, but now I'm thinking in terms of occupations or job titles rather than industries. And one thing that you'll hear people say very often is that, well, lots of the jobs that exist today are going to disappear because of technology, sure, but they're going to be entirely new kinds of work created. There'll be jobs in the future that today we can't even imagine. And that's certainly true. I mean, you can already think of jobs that exist today that maybe a couple of decades ago we wouldn't have been able to anticipate at all. Things like website designers and social media marketers and data scientists. These are all relatively new kinds of work. But if you look at the bar chart on the right here, what I'm showing is that while these entirely new occupations do exist, they really are not a substantial fraction of employment. It turns out that in the United States, about 90% of the workforce is engaged in occupations that existed 100 years ago. So it is things like driving vehicles, preparing and serving food, working in offices and banks and retail environments and warehouses and factories. These are all occupations that someone in the year 1915 would have been quite familiar with. And it still is where the bulk of our workforce is employed. And yet we can see that many of these traditional areas are going to be disrupted. Just to take one obvious example, think of the impact of self-driving cars and trucks. That's going to be millions and millions of jobs just in that one occupation. And of course, it won't be just that occupation, it'll be many others. And so I think there's a real question as to whether, I mean, we can stipulate certainly that new things are going to arise, new kinds of work are going to arise, but there are really going to be enough of those opportunities to absorb all of the workers that need employment, that lose jobs in these traditional areas. And secondly, is there once again going to be that skill mismatch issue where maybe these new jobs created really require lots of skill and education and are perhaps not a good match for a lot of typical people. So let me review for you some of the economic data taken largely from the U.S., but also from other areas. And I think that what this suggests is that technology is already having an important impact on both the economy and the job market. What you see here is a comparison of productivity and compensation for typical workers. And you can see that in the first half of this graph, these two lines are perfectly correlated. I mean, they move in perfect lockstep. And if you pick up any economics textbook, I mean, it will tell you that this is the way things are supposed to work. The idea is that technological progress basically improves the machines that are used in the workplace, and as a result, workers become more effective, more efficient, more productive. They're able to produce more, and as a result of that, they ought to become more valuable, and they ought to be able to command higher wages. And so what you see is that as productivity increases, wages or incomes move in line with productivity. And so prosperity as a result of all this progress sort of scales across the entire workforce and the entire population. So it's a very positive story for everyone. That happened in the United States right up until around 1973, and you can see that at that point, these two lines effectively decouple. And since that time, compensation or wages for most average typical non-supervisory workers in the United States has basically stagnated. And in fact, some groups of workers in the US, after adjusting for inflation, actually earn less than they did in the 1970s. Productivity, on the other hand, has continued its sort of relentless climb there, and so you've got this big wedge between the two, a big gap opening up between productivity and incomes. And I would say that this has already resulted in some political disruption. If you go and look in the industrial Midwest in the United States in particular, there are a lot of people that feel they've been left behind by progress. And this graph really shows quite vividly that is the case. I mean, what's happening here is that really all the fruits of productivity increases and of technological progress are really accruing to the people at the top of the income distribution, to business owners, managers, executives, investors, people like this. And average workers getting almost none of that. And of course, many people are unhappy about that. And I think that is certainly one of the things that led to the rather surprising election result that we saw in November. And it's interesting, if you look at this same graph for the United Kingdom, it looks quite similar. The decoupling takes place somewhat later, but basically you see the same phenomenon in terms of this gap between incomes and productivity. And of course, you saw Brexit there as well. So I think that this is already leading to disruption, and I think that could very well increase in the future. I think that one good explanation, at least in part, for what's happening here is that the nature of machines and technology used in the workplace is transitioning. At one point, especially during that golden age after World War II, machines were clearly tools. They were something used by workers that made workers more valuable and more effective. But now, in many cases, and at least relative to many workers, machines are transitioning to become more autonomous. And what that means is that rather than complementing workers and making those workers more valuable, in many cases, they're substituting for workers or de-skilling jobs and making workers, in effect, less valuable. And I think that's one of the most important factors that's causing this big gap that we see opening up between compensation and productivity. Now, here's another graph which shows labor's share of national income. In other words, the percentage of national income going to labor as opposed to capital. Economists used to believe that that was fairly fixed and stable, and you can see that, again, in that post-war period here, it's sort of gyrating around 65% or so. But then it goes into gradual decline, and then around the year 2000, it really goes into quite steep free fall. It's now all the way down around 58%. So this is really the story of the rise of capital and the fall of labor in terms of their relative abilities to capture income. Now, a lot of economists have looked at this graph and come up with different explanations for it. Globalization is certainly one of the things that might have generated this, the rise of China. In the United States, there has been a rightward shift in our general economic policy, for sure. One thing that we've done in the U.S. is we've almost completely wiped out unions in the private sector. So employees now have less ability to organize and to bargain, and that may certainly be part of what's happening here. There have been other studies that have associated this trend with the growth of the financial sector. That also can result in falling labor share. So there are a number of potential things going on here that you can point to. But here is another set of graphs, and this shows basically the same thing, labor share, but for a number of countries across the world. And the thing that should strike you is that these are quite different countries with very different political systems and different internal politics. If you look at Germany and Canada, for example, I think these are both countries where organized labor has not been decimated, right? It still is still quite powerful and has a role to play, and yet you see the same trend in place there. You can look at China, and that's, of course, the country that we most associate with globalization. That's the country that we all say is stealing all the jobs. And yet the decline in labor share there has been even more dramatic than in the United States. So clearly we're dealing with some sort of a global force here. There's something happening across the entire planet that is causing this to happen in many different countries with different environments. And I think that it's pretty hard to come up with an explanation other than technology that really could explain that. Here is a graph of job creation by decade in the United States. It shows the number of new jobs created in percentage terms in each decade over roughly the last half century. And you can see it looks almost like a declining staircase. You know, just about every decade has produced fewer new jobs in percentage terms. So there's some kind of a structural change happening there. You can see that the last position there at 0 is the first decade of this century, and that's, you know, there were no new jobs created at all, and that is largely due to the financial crisis. But if you look at the last visible bar here, what I'm showing is job creation just through 2007, in other words, up to the point where the crisis began. And you can see that if you sort of prorate that for the whole decade, you know, this pattern would have held. So clearly there is something structural happening independent of the financial crisis. The economy is simply generating fewer new jobs. Here's another graph that looks almost like the mirror image of that one, and this is showing what happens when we have a recession. When we have a recession, millions of jobs are lost. Eventually, they come back, at least in number, and total employment gets back to the same level it was at the beginning of the recession. This graph is showing, for important recent recessions, how many months did it take for the job market to recover in terms of number of jobs. You can see it's taking longer and longer, so this is the story of jobless recoveries. It's almost as though the job market is, in a sense, losing its elasticity. It's losing its ability to spring back to where it was before. And again, I would point to technology as being a primary culprit there. The other thing that's happening here is that, you know, when we have a recession, eventually the jobs come back, but actually they're not the same jobs. It turns out that when a recession hits, the first jobs to really get vaporized are the good, solid, middle-skill, middle-class jobs. In other words, jobs that require some level of training and education, but not necessarily an extreme amount, so they're accessible to most people in the population. They have decent wages, decent benefits, reliable hours, vacations, things like this. So they're the kinds of jobs that you know, most people aspire to. These jobs are disappearing right away, and then in the United States, when the jobs do come back, that job creation is weighted heavily toward less desirable jobs. In other words, lower wage jobs in the service sector, or working at McDonald's or working at Walmart, these kinds of things. So these are a lot less, they don't pay as well, the hours are not necessarily reliable, the benefits are not great. So what you see is there's lots of those jobs and then a smaller number of very high-skilled jobs that require, at a minimum, a university degree. And so this has been the story of polarization or hollowing out of middle-class jobs. Again, it is something that has been observed not just in the United States, but in many countries, including many countries here in the EU. So it's a global phenomenon. And once again, I believe it is technology that primarily is causing those middle-skill routine jobs to disappear. I think there's also a bit of a warning to us here because in the US, of course, we do have a very low unemployment rate, but that is largely due to robust creation of these lower wage, service sector jobs. And there is no guarantee that that's going to continue. I'm aware personally of 3 or 4 startup companies, for example, that are focused on fast food automation. And that's one of the areas where we're seeing a lot of job growth now. So, it could well be that 10 years from now, even these less desirable service sector jobs are not going to be created in large numbers. And that could, be a real challenge for us, I think. So let me talk a bit now about some of the actual technologies that are driving all of this. Robots, of course, have been around for a long time. If you had gone into an automotive factory here in Germany or in any advanced country back in the 1980s, say, you would have already seen big, powerful industrial robots at work. And these are extraordinarily efficient, precise, fast, strong machines. And what all of this automation has meant is that in advanced countries, all of the truly rote, repetitive, assembly line type jobs in manufacturing where you literally stand there and do exactly the same thing again and again, those jobs have already disappeared quite a while ago. So the jobs that have been left for people in manufacturing and warehouse type environments are those that to some extent rely on qualities like visual perception and dexterity that are to some extent unpredictable. And examples of that might be loading and unloading boxes at a factory, or perhaps picking a part out of a bin and then feeding it into the next part of the production process. These are so far jobs that machines cannot do, and so they've been safe for people. But that is something that's changing quite rapidly. What you see here is an illustration of a robot built by a company called Industrial Perception, which is in Silicon Valley. And it was a startup company, but a few years ago, Google actually went out and bought a lot of robotics companies, and this was one of them. So this technology is now part of Google or Alphabet's robotics division. But what you see is, in the illustration, it looks just kind of like a robotic arm, and at the end of that arm is a machine vision camera. And you see it approaching this stack of boxes, and notice that the boxes are not stacked precisely. Some are rotated, there are gaps between the boxes. They're different shapes and sizes. Some have got text on them. Up until very recently, figuring out how to move or load or unload these boxes would have been a visual perception and dexterity challenge that only a human being would have been able to accomplish. But that, this company has now built a machine that is going to eventually be able to move about 1 box every second, and that would compare to about 1 box every 6 seconds for a productive human worker. So you can see right there how that's going to be very disruptive. Also, it's a machine that will work continuously. It's never going to hurt itself. It's never going to file a workers' compensation claim. So you can see right there that as this technology becomes more affordable and available and reliable, more and more businesses are going to come to rely on it. And that's going to threaten the livelihoods for a lot of people. In the United States, hundreds of thousands of people do this kind of work for a living. Now, there's a very conventional way of thinking about this sort of thing, which I think is largely correct, and that says that, well, if you've got the kind of job where you're lifting heavy boxes all day, for example, that's not in many ways a great job. I mean, that's the kind of job where you're very likely to injure yourself. People that do that kind of work for decades end up disabled, then they can't work at all. So, if a machine is going to come along and do this work, that's not something that should necessarily upset us. Maybe we should celebrate that. And of course, there has always been a solution to this problem. The solution has been that we take the worker that loses this kind of a job And we give them more training, more education, right? And then they can move up that skills ladder, do something more sophisticated. Maybe they end up using their brain instead of their back in a much more safer, comfortable environment. Maybe they end up working in an office rather than a warehouse, and so it's more positive. What I want to show you now is the reason that maybe that way of thinking about this issue, though, is not going to be sustainable. That it's going to go, automation is going to go far beyond that. And this is taken from a article that appeared in the Wall Street Journal not too long ago, and it's focused on white-collar automation. In other words, smart software that is taking on more skilled white-collar work. Now, what you see on the right side here is a bar chart showing the number of employees, the head count in the corporate finance department of the largest U.S. corporations. So corporate finance, of course, is, accounting, financial planning, accounts payable and receivable, these types of jobs. And what you see on this red bar chart is that in a recent 10-year period, about 40% of those jobs have disappeared. I mean, relative to the revenue of the corporation. In other words, like number of jobs per $1 million of revenue. Nearly half those jobs have disappeared. And it's largely because of smart software, which is taking on more of the, especially more of the routine work. And in particular will be things like robotic process automation, RPA. And this is really, beginning to have quite a dramatic effect. I think that this is the area that is most relevant to the banking industry as well. Certainly there's, I think, a lot of commonality between these kinds of jobs and the things that people do inside of banks. And again, most of this is because of, so far, RPA, which is really not something that most people would consider to be artificial intelligence at all. It's really a programmatic approach to doing very routine things that can be defined in a step-by-step fashion. Contrast that with what I said earlier about AlphaGo and how it was able to automate tasks that couldn't even be expressed. And you can see that we are really just in the infancy of this, and it's going to get a lot more dramatic. It's going to go far beyond the routine work that we're seeing. But there are many examples you can give of how these technologies are climbing the skills ladder and beginning to impact jobs and tasks done by people with university degrees and even education beyond that. In the field of journalism, for example, there are smart algorithms that can tap into a stream of data, analyze that, figure out what is the compelling story within that data, and then automatically generate a news story based on that. And you can read one of those stories. They're often published by the largest media organizations. You can read one of those stories and it won't be obvious to you that it was written by an algorithm and not by a human journalist. In the field of law, there are many algorithms that are doing document review. There are very sophisticated systems that are doing contract analysis and so forth. So even routine work done by attorneys and paralegals is already being impacted. Of course, on Wall Street, there's been a fairly dramatic impact. I mean, it's not too long ago that trading floors used to be full of people talking on telephones. Now that's virtually all gone. Most trading is now algorithmic. These are incredibly sophisticated algorithms that can, for example, tap into machine-readable news stories and trade on that news within tiny fractions of a second. They can essentially battle each other in very elaborate ways. They can place decoy trades and then withdraw those trades in an attempt to sort of fake out the opposition and stuff. So they're very, very sophisticated AI algorithms that are already out there trading on Wall Street. So I think that what this leads to is a world where virtually any kind of white-collar job that involves sitting in front of a computer, doing some relatively routine task, whether it's the same kind of quantitative analysis or cranking out the same sort of report or presentation again and again, all of that is going to be subject to automation. An extreme example would be a radiologist. This is a medical doctor that specializes in reading and interpreting visual images, medical images, looking for tumors and things like this. And this is a job that in the U.S. at least requires an incredible amount of education. At least 4 years of university, 4 years of medical school, and then 5 years of residency beyond that. And yet, I think radiology is a job that potentially could be fully automated in a not too distant future. So the point here is that additional education is not necessarily any protection against this. What you see here is a graph of recent earnings for university graduates in the United States, and you can see that it's actually declining. So it is true that it's much better to get that university degree than to not do that. University graduates do earn more than people that don't have that education. But even for those that do have the degree, things are not necessarily fantastic. Their earnings have actually been, in real terms, declining. And in the United States, many people are graduating from university and are not able to really find a job that that really leverages their education. A lot of people end up, for example, working at Starbucks. So this is, I think, a real challenge for us because historically, really the only solution we've had to automation and the impact of technology is more and more education and training. And this is, I think, suggesting that that particular solution may not be sustainable, so maybe we need to begin to think outside the box. Another issue that I've really focused on a lot, and I think is very, very important, is that, of course, if in the future we do have unemployment or wages are driven down as jobs are de-skilled, that's a big social problem for sure. But it's also a very important economic problem because the economy, the market economy needs consumers, right? We have to have people who have both the income and the confidence to go out and spend and buy the products and services being produced. If you don't have that, then you run the risk of a kind of a demand shortfall where there isn't enough demand to really drive the economy. Then you run the risk of perhaps stagnation or maybe even potentially a kind of a downward deflationary spiral if there simply isn't enough consumer demand out there to drive things. And it's interesting that as you look around the world today, there are a number of economies where you see very low rates of growth. In some areas of the world, like Japan, you've even seen outright deflation. In the United States, you've got a very low rate of unemployment, but you've also got zero inflation almost, which is quite unusual historically. Usually those things are inversely related. So there is, I think, reason to believe that this may already be having an impact. And of course, you've also got economists like Larry Summers talking about secular stagnation and so forth. And I think that certainly the impact of technology may be playing a role already, but the most important thing, I think, is that as this accelerates and becomes more and more important, it could become a bigger issue. And I think it's something that certainly all of you and policymakers need to really keep in mind that you know, if inequality gets worse, it can have some very important economic ramifications. So finally, where this all leads to is then the question of what could we potentially do about all of this? And ultimately, I think that you can have a very utopian outlook about all of this, and certainly where I live in Silicon Valley, there are many people that view it that way. You can imagine a future where maybe we all have to work less. We have more time for leisure, more time for our families, and so forth. But I do think that clearly we're going to run into an income distribution problem. A lot of people are going to be left behind, and in order to solve that, we need to find a way to, I think, eventually decouple incomes from traditional forms of work. And I think that probably the best way to do that in the long run is going to be some kind of a guaranteed minimum income or a universal basic income. And this is an idea that remains, I think, very radical, but it's also an idea that's getting a lot of attention throughout the world. There are experiments going on in Finland, for example, and so forth. So I think it's a very important idea for the future, and I think it's almost inevitable that we have to move in that direction, although it's certainly politically and socially a tall order. So my point in talking to you about this is really to get you thinking about these issues. I think that all of this may prove to be one of the major challenges that we face in the coming decades. So I think it's very important for all of you to engage in this discussion and debate and to start thinking about this and talking to others. And I hope that as we have that conversation, from that will emerge some real solutions that will help us to find a way to build a future that works for everyone, at every level of our society, rather than just working for a few people right at the top of the income distribution. Thank you very much.
Thank you very much, Martin Ford. And you can stay right here on stage because we're going to move straight away to our panel discussion. And I will ask our two panel participants to please also join us over there at the counter. So a very, very warm welcome. It's my great honor to introduce our other two panelists, and I'll begin right here with a warm welcome to José González-Páramo. He is a member of the executive board of Banco Bilbao Vizcaya Argentaria. I hope I'm more or less, no, not quite right. Okay, well, he'll correct me later. He serves as the group's chief officer for global economic regulation and public affairs, and also as chairman of its international advisory board. And he was formerly a member of the executive board here at the ECB, and also has served on Banco de España's governing council and its executive committee. So a very warm welcome to you. Thanks for participating in this discussion. And next to him, we're very glad to have with us Dirk Vater. He is partner in the Frankfurt office of Bain, the consulting company Bain and Company, and he heads its global retail banking practice with a particular focus on major transformational programs and strategic development for financial institutions, including, above all, digitalization. So warm welcome to you as well. And we're going to now try to bring this to the banks and talk about that technology and banking nexus. And Martin Ford, I know you're not an expert on banking, so I'm going to suggest that in the initial part of this discussion, you just jump in as you like. Just give me a sign if you want to add something or comment. And I'd like to begin then to talk about how does the relationship between fintech and the banking sector look at the moment. And we heard Danielle Nui say earlier, she thinks we've come to the point where there's a mixed role for fintechs in relation to banks, namely as both partners and rivals. So asking you, Mr. González-Páramo, you have said in the past that it is certain that banks are going to change. The main question is, are they going to steer that change proactively, or are they going to be changed? And if you look at where banks are heading in their relationship to fintechs. Certainly there was initial skepticism, even just a couple of years ago. There was perhaps a little bit of indifference mixed with skepticism, but increasingly we are seeing banks absolutely embracing both startups directly and also creating their own accelerators. So the question would be, is that the kind of proactive approach that you think is needed?
Yeah, of course. I mean, your question has many sub-questions. So let me first say that, of course, banking will change. Not all banks will be able to change, because it's not just about putting apps in above the glass in this device, but also changing the processes that are below the glass, which is not trivial. There will be different modes of interaction with fintechs. Of course, some fintechs are real competitors and go straight to the most profitable lines of banking activity. Think of, I should not name names, but there are big payments fintechs that are not anymore startups, are giants in the field, and these are real competitors. But there are other modes of interaction with the fintechs that could be profitable in helping the banks to change within. So you could think of M&A strategies when it is convenient, or to have partnerships with EINs that could help you, for instance, in the cloud domains or in blockchain. So partnering with Google or with Amazon or with Salesforce would be a clever strategy in this domain. You could even buy some in order to fertilize from within domains as, say, loans to SMEs, which is an area where there are many fintechs that do very good work in scoring, for instance. So if you team up, as we do, for instance, in the US with On Deck, in order to identify the risk profile for SMEs, you increase your business. You could have also ventures. Also, so as an investor in ventures, you are uncertain as to whether they will succeed or not. So cooperation and competition between us. But underlying this, I think, is a very important thing. If you don't have the vision on who is going to be your competitor going forward, if you think that your competitors will be all the banks and not the fintechs or the big giants in the net, you're dead. Because you have to provide the same customer experience as they do. And they are the masters of this. And in order to be able to be at the same level, you have to work like them. And this means very deep changes in talent and culture within organization, technology.
Very, very good. Thank you very much. And I want to come back to the details of how that can and needs to look. But let me ask Dirk Vater, in your global practice, what are you seeing in the way of investment shifts on the part of banks? Are they moving money increasingly into, for example, artificial intelligence, as Martin essentially predicted in his keynote?
They don't have another choice. What we see around the world is absolutely the fact that banks are heavily investing in digitalization, but depending on their own strengths, on their financial strengths, and of course on the leadership team, how convinced they are about the digital strengths of the future. And there we're going to see the differentiation very strongly between winners and losers in the industry, because there are banks who are already still suffering in their local, national, regional competition. And there are also banks on which the leadership team is not as much convinced about the technology trends as perhaps probably Mr. González and myself are. But let me put one point on the question before, because I often hear that our banking embracing the fintechs, and just want to correct this in the name of the bankers, because it's only one direction. What we do see around the globe is fintechs are also embracing the banks, because there are some very few ones who are very successful, and they are going to survive and succeed without bank collaborations. But I would say 95% of these fintechs, as in all startup industries, they are struggling, and they're struggling with one fact: this is the number of clients. And that's why the fintechs are also embracing the banks. Unfortunately, these weddings, which are happening all around the globe, I think there has been not the silver bullet yet, how to run a perfect collaboration between fintechs and banks. Is it only collaboration? Is it investments? Is it full takeover, integration of the team? So these are still, the whole industry are still sorting that out. Last remark, what we do see is, because they are not missing clients, a much bigger threat coming now from Mr. González said, big giants or the big tech companies, because they are stepping into financial services, especially in my sector, in retail banking, all around the globe. And they are, from the day one they are entering these markets, they are at scale which no local or regional bank could run when they are entering a fintech market.
Let me ask Mr. González-Páramo to perhaps comment on that and whether that he sees that as a threat, but also the question of motivation here. When banks embrace fintechs, what's driving that? Is it simply the desire and need for greater profitability? That was something mentioned earlier by Danielle Nui in her dialogue. She said, look, they are hoping that this will drive them toward greater profitability. Would you say that's the main motivation?
Well, of course it is, because this is one of the main drivers, not the only one. So, but you have to understand that the economic environment has not made life easy to the banks. So there is still a lot of damage in the balance sheet of the banks. We spoke about the NPLs. Second, rates are low, connected to the former, and with low rates, the revenue side is a bit impaired. Third, reputation. Banks are not cool. So young generations are not vocationally getting close to the banks, neither to work nor to do business with. Regulation, and this is putting pressure also on returns. So finally, you have digital. And digital you can see as a threat, and then you resist, or as an opportunity if you understand that your client is changing fast, because internet is redefining the consumer experience that they want. So you have an opportunity to get closer to them and to overcome the reputational issue if you deliver what they want 24/7. And this is the real challenge. But also the business models that you are facing are different. It's not taking deposits just to make loans. Business models are concentrating in niches like many fintechs do, or business models associated to data. Data is the essential thing that makes this revolution different, because these technologies were out there time ago, but they didn't have enough data to produce knowledge in order to deliver value added to customers. Now the amount of data is immense. And if you understand this, it is not just about profits, it's about having full conscience that the customers are entirely different and are changing very fast. It's not just millennials or centennials, this is also ourselves. I'm a digital immigrant, but I see the advantage of this. And these new business models, if you don't realize that you have to compete with them using agile technologies and flexibility as they do, you are lagging behind.
So, assuming that those are the goals of the banks, Dirk Vater, will the way they're approaching this deliver that? Will they, in fact, fulfill the goal of increasing profitability with their approach? I have had fintech entrepreneurs tell me, look, if banks really want to disrupt themselves and get more innovative, they're going to have to do more than just buy a startup here and there or create an accelerator. They need truly proprietary R&D under their own roof, essentially moving into innovation the way that a startup would do it and not simply outsourcing this.
The answer to this, to be clarified, because now the tipping point is the data, Mr. González was talking about. Because so far, banks digitalized. They digitalized, most of them on the front end, customer experiences, new apps, new solutions in interacting on the customer interface. But most of the banks were sitting on old IT legacy systems, which were totally not the same like a new fintech starting their company from the very day on in the cloud, having totally structurally different cost positioning. But here comes the point now, why artificial intelligence and blockchain probably also is, from our perspective now, the real disrupting technology, because now banks will be able, with artificial intelligence, to substitute processes which are repetitive. Yeah? Really the lower end of the scale, what Mr. Ford already said, and but also some business will be easier. Approaching clients will be easier with data, not only on the physical, not only on the online channels, but also on the physical channels. We also already see examples in Asia, for example, where banks are using artificial intelligence in their wealth management relationship approach. Yeah? Saving 2 hours per relationship manager a day. Yeah? And so the first time now we are seeing with artificial intelligence and potentially blockchain to come, to really taking cost out of the industry, and therefore at least bringing profitability to a reasonable stage back.
Mr. González-Páramo, may I ask how you see the relative merits of those two technologies? And when you speak with other bankers, what is their approach? Because I have certainly heard that whereas banks are putting more focus and emphasis on AI, many startups, many fintechs think blockchain is going to be the big thing. Would you say it breaks down like that, or is that too simplistic?
Well, I would not put both at the same level. They are not competing technologies, but they would reinforce each other. They do different things. So artificial intelligence helps expand our minds, our brains, and eventually at some point replace us, or many of us. Blockchain does away with intermediation because it decentralizes confidence. And in a world which is made with many intermediate steps, it will be revolutionary. Second is, I think the stage at which we are in terms of developing the blockchain is not comparable to artificial intelligence. Blockchain, I think we are a few years to have a standard. We are involved in all the main initiatives dealing with blockchain, but blockchain has to solve many issues, including legally, because it's associated to the smart contracts and computer capacity. There are many things. Artificial intelligence is there. You speak to your phone. You speak to Siri or to Alexa. In Echo, and this works. You can manage your account just with your voice, because biometrics and voice recognition is there, is absolutely ready. So I don't think they are competing. Stages of development are different, but they will, of course, be part of the future set of technologies available to the banks.
So, Dirk Vater, what exactly is that going to mean for the user experience, for the bank customer in future? How's my interaction going to look with my bank? Or am I even going to be interacting with my bank at all?
Of course you do, depending on the segment you are. depending what, at the end of the day, you can afford to pay for these services. For a lot of, in the retail space, we think it will be all digital. Yeah? You are interacting with Alexa on Echo. You are interacting with voice, with your face recognition, with your every biometric tool in onboarding with the bank, but also in the overall process. You don't need physical client advisory services. It probably will change as more attractive or more wealthy the segment gets, and as more complex the advice gets, because will be, it's a function of unsecurity and a function of the duration of investment decisions you as a customer are doing. And as longer and as more complex and unsecure, as more people will be needed to help you to find these decisions. And that's going to be in affluent and in wealth management banking, but different than before, because there will also be machines will support these kinds of decisions.
Martin, can I ask you to just jump in here? And you're welcome, by the way, to also speak to the point about blockchain, if that's something you're familiar with. But then I'd like to ask you about this as well. Go ahead.
Okay. Yeah, in terms of what it looks like in the future, actually, one place to look there is China, because they are really ahead of the curve. There's an app called WeChat that you may have heard of. It's put out by the company Tencent, and people there do everything with it. I mean, all their banking, paying their bills, everything can be done through this app. And I think that the future looks a lot like that. And of course, all of that just generates enormous amounts of data, and that ties into what can be done with machine learning as well. And that's why Tencent is one of the leaders in this area. So I think that this integration of the tech companies and banks is something that I kind of expect. One point you can make is that the tech companies have enormous capital that could be used to acquire banks as well. So they may actually at some point in the future become banks and compete directly. That's one thing that many people, I think, expect. As to blockchain, I do think it has enormous potential. It's also subject right now to enormous amounts of hype. I mean, it's become the latest and greatest thing. And so it's very hard to really sort of weed out exactly what's happening there. But I do think it has great potential to be very disruptive.
So, Mr. González-Páramo, if all of this were indeed to come to pass, that I have less and less contact with my bank directly, why would I then be loyal to a bank? Are banks going to have to get used to the idea that they have essentially customers coming and going, and there's a much more fluid relationship than there has been in the past?
Well, there are two dimensions to your question. First, there are two strategies as to the incumbents now. Either you try to adapt and resist and become slowly an infrastructure, like the telephone lines, PSD2 is the payments directive. Number two is requiring the banks to open up their networks for third parties to operate on them. This process will go and go and go. And if you don't have the capacity to see that you need to keep the direct relation with your customer, you're basically dead as a bank. And the second answer or second dimension has to do with the different modes of interaction that young people have between themselves. You have seen youngsters sitting alongside, talking to each other in the social media, and they don't feel far away. It's the way they interact with. So to the extent that you deliver what the customers want, you are close to them in spite of the fact that they will go less to the branches, because this is not the mode of interaction anymore. Young kids don't understand what a branch is for. So if you are there 24/7, okay, loyalty will be less than in the past, certainly, because now with one click you can compare. And comparison and transparency is one of the new ingredients. But if you start from a situation, and this is the general situation of banks, where you have the trust of your clients, so you have consent to use their data. So you can pull this data with the data that is out there in the internet. Using big data techniques, you generate knowledge. And with knowledge, you produce value-added products that are satisfying to them. You have a virtuous circle that you can reinforce to your advantage, regardless of the fact that you are not in touch physically. Of course, this mode of operation will be open. But now we talk about omni-channel experience. where you talk to an employee in a branch, or you go through the iPad or through the mobile or your laptop, you get the same kind of experience, even the same visual appearance of things, and of course the same message. That's key. So contact with clients is not lost, and this is the bottom line for the fact that you interact with them through different channels, which is the general trend.
So that was the user and customer side. Let me ask about the other side. And in view of what we heard from Martin Ford, would you advise your daughter or your granddaughter to become a banker?
That's another question. I'll see what the capacity is when she blossoms. My youngest daughter is a fascinating profession, I have to say, especially at these very
Will it remain one?
momentous times.
But will it remain one if we have artificial intelligence moving into the highest echelons of decision-making?
Absolutely, absolutely. Because this is about understanding that banking is not just about deposit taking and giving loans, but it's about making accessible and easy everything that is connected to finance. And this is not replicated, as far as I can imagine, by any robot or artificial intelligence. So anticipating what you want, and this is big data and consumer experience. For instance, you're looking to a building and see flat number 2, how should I start to negotiate? Now you have an application in the mobile, our bank offers that says, okay, this is the assessor's price that you could start with. And of course, associated to that, we are ready to know that this person might likely ask for a loan. Finance is a source of stress, which ranks number 1 in many surveys. People prefer to go to the dentist than going into a branch of a bank because it's complex, because it's very important. And if you are mistaken, you can be broke at some point in time and not saving sufficiently and so on. So advice, again, is not deposit taking and lending, but it's also advising people. This will never be, I think, replicated by a robot or artificial intelligence.
Dirk, Vater, what do your studies show in terms of the impact on bank headcount and the footprint of the industry as a whole?
First of all, in terms of what kinds of qualification capabilities is needed in the future, and I think you can summarize it that you need people who are very creative, who are critical intelligent, and who are emotional intelligent, because that are, cornerstones which differentiate you for analytical intelligence, so keep you safe in comparison to robots. So in terms of, these are definitely jobs which will be very important also in the future in an industry which is transforming in a such huge way as banking is. In terms of numbers, we analyze the different processes and divisions across business lines. And of course, depending on the individual point of departure of a bank, but in summary, we would argue that 30 to 40% of jobs in the overall industries are at risk through artificial intelligence right now.
Martin Ford, do you care to comment, perhaps also on whether you'd advise your daughter to go into banking?
It's not so much banking or another profession, it's really what kind of job are you going to do within that. And I would agree that right now, as we look at least to the next couple of decades, the qualities that are likely to make a job relatively safe for human beings are, number 1, creativity. Are you really generating new ideas, thinking outside of the box? And number 2 would be interaction with people on a deep level, having that emotional or the ability to really understand another person and where they're coming from. So those kinds of jobs that really rely on those qualities for the foreseeable future, not forever. Eventually, nothing is off the table as these technologies advance, but I think that they're going to be relatively safe in banking and also in other occupations. But the main message is that the last thing you want to be doing is something that's routine and repetitive and predictable, right? If you're doing the same kinds of things, again, then it's definitely going to be susceptible to automation.
If I may clarify on this one, is less accountants, to be very plastic and graphic, and more about STEM abilities, so science, technology, engineering, math, experience design, and you have designers out there that sell things just because they go into your eyes, and of course IT experts, IT architects, because now you need the special IT skills in order to design very flexible IT systems. And of course, cloud experts, big data experts. This is the profiles that now make it in banking.
Thank you very much. Let's talk about another occupation now and creativity, and that would be the occupation of regulators, because, of course, they are facing new entrepreneurs who don't necessarily fit the old paradigms. And my first question to you, Mr. González-Páramo, would be whether supervisors are equipped to handle the kind of transformation that we're talking about. We've heard all of you saying we're going to be looking at firms coming in from entirely different industries and essentially moving into this space. Would you say that, at the moment at least, that supervisors are enablers for innovation in this area, or are they essentially putting the brake on it?
Well, there are many different types of situations, but supervisors and regulators like banks are now grappling with this new, brave new world of digital change. So I understand that you may find very conservative regulators and very progressive regulators. Given that we are now sailing without any maps, because this is entirely new, I think the collaboration culture is essential in order to learn from each other and understand each other. Of course, you may have a very safe pair of hands trying to block all initiatives that are not foreseen in the rule book. Okay, you may have a very safe system short term, but in the long term, it will be little profitability and ends up with the death, probably, of many banks, because this gives advantage to the startups and fintechs. A second thing is level playing fields. I think this is a very serious issue, because level playing field means that same regulation for same type of activity. And it makes little sense that for the sake that one activity is being performed by a bank is regulated differently than a startup. There was a recent study done by the European Banking Authority and published in spring, where you find out that at least 1/3 of startups and fintechs handle money from clients without being subject to any regulation, not even AML, which is a bit scary, because this, in the case of a big scandal, it could have knock-on effects on confidence across the board. And final point, if I may, progressive regulators now are embarking on understanding that they have to allow experimentation in safe environments. And this means having or putting in place innovation hubs or sandboxes, and also investing in the skills that will make them able to understand what's going on, which means hiring engineers, hiring design experts, hiring cybersecurity experts in order to conclude something, for instance, on the relative merits of cloud computing vis-a-vis mainframes when it comes to security and protection of individual data. Because you have many that say, cloud, whoa, that's very complicated. Where is your data? How safe it is? It looks like if it is in the air, and in the cyberspace is more prone to hacking and to alterations in the data of consumers, and this is not what the experts tell you. So you have to invest in these qualities in order to understand, really, whether you should allow things and put banks in the same footing and on a level playing field with the startups. We acknowledge that we start with legacies in the IT domain that we could overcome more quickly if it were not for the conservatism of many supervisors and regulators.
Dirk, Vater, perhaps you could weigh in on this question of how we get it right with the playing field. One model that's out there is the UK. Its Financial Conduct Authority is viewed by some as a model. It prides itself on being a forum for exchange in order to try to tease out some of the issues that perhaps, and the new paradigms. Is that, do you think, a potential model? And when have the kids outgrown the sandbox?
First of all, when I'm talking about the impact on regulators, I'm always make the comparison that digitalization or new technology, if you discuss that, you usually think about new customer experience, digitalization, as I said before, frontline, a little bit IT. Usually in banks or in organizations, the impact on HR, on compliance, on legal, on finance, all other overhead functions or controlling functions are often forgotten. But the whole organization, as we already talked about, has to adapt. There are new ways of working, agile working methodologies, for example. So, and as these controlling function has to adapt, of course, also regulators have to adapt into these new technology time. And yes, what was invented, I think, in the UK, but is now, I don't know, I think in 10, 12 countries, Hong Kong has it, Switzerland has it now, Australia, different countries in the world, using this sandbox system to allow, on a temporary time, new tests, test and learn. We always argue that in the digital space, everything is about test and learn. Yes, then of course, regulators and sandbox is a way to find that, to test and learn. And we agree that this is probably the way how it should be derived in other countries as well.
Can I just ask you, because you are based in Frankfurt, BaFin, consumer protection, very high in the BaFin mandate. Fostering financial sector innovation is not an explicit part of that mandate. Does that create problems for a regulator? Do we need to think about perhaps defining regulators' mandates in a different way?
Oh, that's a complicated question, because I think in the past, regulators already have done a lot of created a lot of innovation opportunities in the name of the consumer, which are still facing the overall industry, and which PSD2 is, for example, one of them, and which we still don't know what the impact of these regulations at the end of the day will be in the name of the consumer. So before we come up with a new way of how to sort out things, I would love to digest first everything what we have put on the table from the regulator to see what the impact at the end of the day will be. Because PSD2, just as a last sentence, is highly underestimated by a lot of players all around Europe. I'm 100% sure.
Just to add a point on this one, not about BaFin, of course, which is, of course, the objectives of regulators, which are not always the same institution. BaFin has to combine or liaise with the Bundesbank and others here, because there is, of course, solvency, financial stability, consumer protection, and the integrity of the financial system. And all those objectives are equally valid today. But the way you secure how you get there has to be different, of course, when the technology differs. So consumer protection today means, in an overriding way, protection of data, avoiding denial of servers, so good systems against cyber attacks, but financial stability should be also in the radar screen. What is financial stability in a world made up by a small number of banks and a lot of fintechs and big techno companies? Does anyone understand this landscape? So I would like to hear reflections on how you secure financial stability in this world. What about solvency? And of course, integrity. Integrity is a crucial part. I mean, you should not allow by any means, and the bad guys with digital have more reach. AML should be as stronger as before. You have means, but also the bad guys have the means to do the bad things. Know your client. Again, this is very or equally valid as in the past, but the way you secure that is entirely different.
Let me bring Martin Ford in on this point, because there is, of course, something called RegTech that says there are technical solutions to the problems that we're talking about, that RegTech is in a position to essentially know the client much better and much faster than any conventional means of doing so that we've had in the past. Would you think that going forward we will see regulators as well essentially become learning machines?
I think to some extent that will definitely happen, and will have to happen, in part because a lot of these things are going to move so fast in terms of the threats that come, especially cybersecurity threats and so forth. A lot of that is going to move at a rate that people can't reasonably deal with. So I think we will have to rely on artificial intelligence to meet a lot of those threats. But more broadly, I mean, there is a lot of creativity, as you say, involved in figuring out how to regulate new technologies, and that's not something that machines can do yet. So there's definitely a very important role for people there. And I think you think back to the financial crisis in 2008, there was a lot of discussion then about how regulators weren't equipped to deal with derivatives, and that kind of thing can definitely happen more in the future. So we need people that are very prepared to deal with rapid change.
Let me come back to the questions that I asked to the audience at the outset and the question of risks and benefits, and then I want to go to audience questions in general. But last question to both of you, Mr. González-Páramo and Mr. Vater, with the request for short answers, if you would. The Financial Stability Board definitely sees both benefits and risks, and in a recent report, it highlighted two particular risks. One, third-party dependencies, meaning the rise of systemically relevant actors who are outside the regulatory framework. You both touched on that en passant, but maybe you can say a word about that. And secondly, the lack of interpretability and auditability of AI and machine learning. In other words, models that are opaque, and possibility that those could lead to unintended consequences. And this is something you hear in every industry. It's by no means confined to the financial sector. I recently was at an additive manufacturing event where the TÜV, Germany's essentially quality supervisor, said, we actually are looking at entirely new processes that we don't understand, so we don't know how to certify them.
So I cannot agree more with these two conclusions, but those can be addressed in a very clear way. As regards third-party liaisons, business continuity requirements should be there. If you treat these third parties, say, like externalization, and you are thinking of the cloud, there are ways to ensure that you don't depend only on one provider. Also, you should push as a regulator for interoperability of clouds in order to be able to ship your data immediately when you wish, so you are not locked in. And of course, there is this very important issue of kind of auditing, knowing what goes in or within the artificial intelligence world, and it's quite a difficult thing because algorithms could inadvertently discriminate against the people based on ethically or morally irrelevant characteristics, features like the color of your skin or where do you live. And one should be very sure that an algorithm is not introducing discrimination through the back door. That's going to be more difficult, but I think these new technologies could help also in the auditing of both artificial intelligence and the very specific part, which is the algorithmic link into decision making.
Full agreement, because I don't want to repeat, but perhaps another thought on the second one. What I'm always discussing when I'm faced with fintechs and incumbents in discussions, fintechs always arguing then the incumbents, how many tech competencies do you really have in your boardroom? How many tech competencies do you really have in your leadership team to really at the end of the day understand what the impact of the strategic steps you are doing will be. So, and this is definitely, with all honesty, one of the risks that we have to upgrade the game on technology. Fintechs are tech companies, not fins. They are all technologists. They come from the technology side. They learn financial services as an add-on. Banks are coming from the other direction, but I unfortunately see too less steps in the way that we are really embracing technology as a capability. And there's also one big hurdle that our incumbent industry, that's why we are not so opened for the war of talent on these tech people. Or let's face different message. We are open, but they are not so much attracted by the industries because they, in the incumbent industries, doesn't feel themselves fully understood. And there's a chicken-egg problem which we have really to crack to upgrade the game and to minimize this risk which was laid on the table.
Thanks very much. Small anecdote related to the fact that these are tech companies and not Finns. In the reading that I was doing before this event, I encountered one regulator saying, you know, it's really funny because we talk to these fintechs and we can't find any lawyers. As a lawyer, I found that very interesting. Who has a question for our panel? If you have one, raise your hand. Yes, please. We have a microphone coming to you.
I would have one question, basically to Dirk Vater. How would you suggest to banks and also then to supervisors to approach artificial intelligence? How should we build up the capabilities, and how do you suggest to do that then?
First of all, you should think about the different use cases where you, as a bank, as a regulator, use artificial intelligence. What I always or often see that everybody's claiming for the big data lake and saying we need hundreds of data scientists, and there's no clear use cases which have to be defined for what you need these data scientists. And then this is the second step. You have to hire this talent. You need data scientists all over the place. I was on one conference, and the guy, I don't remind his name, but he said, one day there will be more data scientists in bank than risk managers. And I tend to agree on this quote.
If only because risk managers would be experts in big data.
Yeah.
Because now,
true.
now risk management is being done on the basis of big data. I know that well from our bank.
Who else has a question? Please. Mr. Tucker.
There's this lady behind.
This is all going to change the way that banking is distributed and what the products look like. But is it going to have any material effect on the structure of bank balance sheets? So if you were Danielle, you should be a bit interested in this, but should you be very interested in it in terms of ensuring the safety and soundness of banks? I'm obviously not convinced that she should be more than a bit interested in it. As a citizen, very interested, but given her responsibilities.
I mean, this is just a guess. I presume that the deposit-taking activity earmarked to granting loans will reduce its weight in the balance sheets, and the profit lines to the banks coming from other sources would increase, associated to fees and commissions on advice and all these services connected to finance. Wealth management is going to go up in all balance sheets. Also, regulation is pushing in that direction. So if I would have to give a hunch, I would bet that the loan part and the deposit-taking part of the balance sheet will go down.
Vater, do you want to add?
I would agree this. I mean, there are some substitute models already out there which are replacing parts of the balance sheets. Yeah? Need to be proven whether they are successful as alternative models, peer-to-peer lending. I hardly doubt that this will be such an impact that it will highly influence Danielle's perspective on the balance sheet. But nevertheless, I fully agree. Yeah? These directions on the balance sheets, what Mr. González said.
Thank you. So I had a question in the second row. The lady, if you will put your hand up again so he can see you. Yes, over here as well. And then also Ignacio. It's on.
So I was a bit less optimistic about the impact of fintech, and I think we should go back and go on the call that Martin Ford was giving, that this is a threat, and it was already proven as a threat to the manufacturing sector. I wonder whether it's a threat also to the banking sector, for the very simple reason that banks exist not because they produce goods, but because they have a monopoly rents, which comes from the fact that they manage information. The moment that with fintech, everybody discloses voluntarily his information on the platform, both consumers, depositors, and borrowers, investors, there is absolutely no service that they are providing. So they have to come up with a new service for their own existence. And it's not only in that case the fact that people are losing jobs, so financial advisors are replaced by robo-advisors, but simply because the mere existence of the service is under threat.
No, I would just say that you are, I think, reflecting on a static way, because this is a very dynamic world. What banks do today has little to do with what banks were doing 10 years ago. So it's now understanding your client and accompanying the client throughout all the financial journey, which is not just a given service like making a payment. Of course, payments is quite a juicy part, but this is under threat. If you provide the confidence, you handle the data of the clients with extreme care to the extent that they rely entirely on you. You are permanently anticipating needs because you know a lot of data and the journey and the family situation and what they need and what their business is, because you're a bank, basically. And you can combine this information, what the information that is out there. You're changing constantly the way you provide service to your clients. And this cannot be put at risk, if you are sufficiently aware, by any given fintech. Real competitor could be the big techs, because they have a lot of information and they can combine it in ways that are extremely clever with an unlevel playing field, because they don't give you the information they have to us, the banks. But they don't want, at the moment, to be regulated like banks. That's a great thing, because they don't want the hands of the supervisors to be put in the core business of these institutions for a good reason. But at some point, they will find a way. And this is why I said at the beginning, identify your competitors. Going forward, it is not other banks, it is these guys.
But of course, it does seem that there are some banks who don't see it quite as optimistically as you do. I think there is a legal complaint, actually, from a group of fintechs saying that banks are denying them information and data that they need in order to make some of the transfers that they have, in fact, been hired to make by clients.
I think that's a publicity point. But that's not true. On the contrary, I see that, and it's a good thing to have competition with fintechs, because this makes us better and stronger. But that's not entirely true. We are obliged now by the PSD2, by the Payments Services Directive number 2, and also by the GDP, sorry for the acronyms, the Privacy Directive, or no, the regulation that enters into place next year, and we are abiding by that. We could put the question in the other direction. There are techniques in order to access the data of clients which are not foolproof in terms of protecting privacy and data. Think of screen scraping. And we are not yet there as to the choice of the technique that these third parties use in order to access data from clients. I would not like one of these startups to pretend it's me operating on my behalf, but under the instructions of a bad guy.
Thank you. So I think Ignacio had a question, and also I'll go ahead, please, Ignacio.
Automation in banking has been going on for a while, and yet I don't think we've seen the type of the decoupling between earnings and productivity that Martin has showed for the manufacturing sector. Actually, bankers keep being paid pretty well at most levels. Do you have any interpretation for that?
I don't know. I'll give you a chance while I think about that.
Thank you.
Can take it back if it's too difficult.
No. I think you are addressing one really important part, which is a lot of banks still mix up automation with digitalization. And through the golden angle of we digitalize now everything, they want to fix homeworks which should have been done for decades. So what I'm saying is, and I made this point already, the old legacy systems had been always a good excuse for not optimizing processes very efficiently. And now, a lot of banks think through digitalization, this is all gone. But at the end of the day, I know this quote is also very old, you're still digitalizing old bad processes. So what you really have to do is really rethink your overall business model, and therefore artificial intelligence can bring us new ways on how to create businesses than it has been before.
if I can just make a point, I am not aware of any study that compares remuneration and says, okay, at this and this and these levels have gone up or stayed or gone down. What I can tell you is that there was a huge overcapacity in the system and remains. Now there are many more and more banks that close branches when the profits that they obtain from the branch are less than the cost, and this is a rational way to go. But as regards the productivity such, I'm not aware of this kind of thing. But what I can tell you is the following. Regulation on occasion is not helping to hire talent that is externally well paid out there, because there is a regulation on the limit, ceiling on remunerations, the bonus vis-a-vis the fixed part. And out there, the smart tech guys are used to kind of success payment, which surpasses by many times what is fixed in our remuneration. So we are deliberately or inadvertently, I don't know, putting banks at a disadvantage with other industries that want to innovate themselves. So in that respect, I would like to see more flexibility, especially when they don't create a genuine risk, or when you can ring fence the activity of those professionals that help the banks to change from within and be more profitable. But whether the remunerations have remained very high or low, I'm not aware of any study.
Thank you. Last question.
Yes, I have a question about the artificial intelligence, and it goes back to the beginning of the presentation of Mr. Ford. I also was surprised to see AlphaGo, the new player, the new artificial player created, and that was so successful, beating humans many times. As I understand, it was amazing that the game, the machine learn on its own without being taught. But I've played Go a couple of times, and as I understand it, it is a purely deterministic game. And life is stochastic. Not only life is stochastic, we don't know the underlying distributions. The probability distributions are unknown to us, and we humans, more or less successful, react to that. So my question is, will artificial intelligence move to the next step and cope with a stochastic world?
There's evidence to suggest the answer is yes. I mean, certainly the researchers in the field are working on that. In fact, DeepMind, the company that did AlphaGo, they're very interested in it. They're moving on to other kinds of games, video games that require advanced planning, for example, and these kinds of qualities that are more like real life. So you're right. Right now, it is limited to very deterministic things, and artificial intelligence, as it exists today, is very narrow and specialized, and it can do certain specialized things at superhuman levels of competence. But it will certainly get broader and more capable, and no one really has the answer to exactly how far it can go. But many people expect that ultimately, it will exceed us. It will be smarter than we are. So that's something to look forward to.
And what that means, we will address perhaps at a future Congress. But for now, let us please give all of our panelists a very warm round of applause.
So thank you.
And we go now to a coffee break, and we'll return probably in about 20 minutes, more or less. So thank you very much for your attention, ladies and gentlemen, and for your good questions.